Good morning, good afternoon, good evening, wherever you are. Thank you for joining us for today's public webinar, Preparation for the Jobs Report. Good morning, Jim.
Good morning. Good morning. Every time you attend one of these, you hear me say we do these free webinars in order to draw your attention to how we approach the markets and some of the educational programs that we have. I'm just going to briefly touch on it, and we'll come back with details later. But the next course that we have coming up, and Jen, what's the start date?
It is from August 2nd to 10th.
Is called the primer. It's an 8-day course, and it really it's our inexpensive way for you to see if you like what we do, trust what we do, and think you can get value from it. But that's really, it's just a way to get a pretty good chance just to see what we do. The first 4 days are linear, to give you the basics. The last 4 days, we try and interact with the market to give you a feel how it fits together. It's just basically an introductory course. But we'll come back and talk a little more about that, as well as our major course. We'll have one major course in the fall, which we call the intensive. The intensive has a prerequisite to it of the foundational e-course. The primer does not qualify you for the intensive, but we'll come back and Jen will give you details in a while.
But I will just mention up front that all of the webinars are recorded so that you can go back to review them if you're not able to attend live. Okay, sorry, Jim.
Okay. And of course, our most asked question is, are the webinars recorded? All right, so where I'm starting with is a big picture. And this is one of the things that the last several weeks up until yesterday have been a struggle for me from a trading standpoint, because I have mistrusted the market. So, I mean, anything I've done has been very, very short term, in and out, not taking anything, home overnight or anything of that nature. That changed yesterday. And we'll talk a little bit about that. The bar chart, the daily bar chart that you have in front of you shows 4 gaps. Anybody that has spent any time listening to the webinars or some of the educational courses know that I have historically said that, markets go from one extreme to the other. But one measurement that I have always used as an indication of when the market is extreme to either the upside or the downside is relative to the number of gaps. 3 gaps, I've always said that in excess, 3 gaps and more signals to me a high degree of concern that the market, if the gaps are to the upside, a high degree of concern that the market is out of hand and overextended. As you can see, there's 1 gap, 2, 3, 4 gaps. So coming in, when the market gapped higher last Friday, was the 4th gap, and the way it went up, that was what really put me on alert that the market was really getting out of hand. Now, this is what I'm going to say now is really important. And what I look at are 2 scenarios. One scenario, and it doesn't always happen this way, but when the market's overextended, as it is now, I look at 2 scenarios. Scenario 1 sees the market correct, but all that correction does is allow short-term inventory to come back into balance. And maybe short-term and maybe some intermediate-term inventory come back into short-term balance. Then the market proceeds on its way to the upward extent. The other is that the market, when it starts to sell off from here, is actually the start of a new downward trend in the market. Those 2 scenarios are quite different. If you don't understand or, keep in mind the two possible scenarios. It's very easy to get trapped in the wrong one. And it's just something that is, you're looking day to day to see what kind of volume, what kind of profile, what kind of confidence does the market have on the downside. And sometimes when the market sells off too fast, that is low confidence. It's just people panicked and get me out. And it sets it up for a rebound. But again, it's too early to tell. We will be doing, a few more webinars to take a look at. But that's where we are right now. So now, with that in mind, let's go to my screen, Jen.
Okay, let me give you the screen. 1 second. There you go.
All right, so this, when you see the dark area here, that is the gap from last Friday. When I see a gap, and I said the last several weeks have been a struggle for me because I haven't trusted the market, and it's made it very, very difficult for me to have any confidence. I could clearly see the trend was going up, but I didn't trust it. So it's been a struggle. But when the market goes up as it did last Friday, that is a real warning sign to me that the market is getting very, very late. We have what we call the diffusion model, and it shows, the early people into either the long side or the short side, and this side time we'll approach it from the long side, are the innovators. The innovators are followed by the early adopters, early majority, late majority, and finally the laggards. The laggards are those that have watched the market and they finally, after months and months and months, they decide they've got to get in the market. This big gap last Friday is very indicative of the laggards, and they finally throw in the towel and they're convinced, and they come in and just they can't control themselves any longer, and that very often gives us a market high. Now, one of the things that you also hear me talk about is a healthy market. If it's a healthy market going to the upside, the market will trade higher, move sideways, get some consolidation, trade higher, move sideways, get some consolidation. It's kind of stair-stepping up. And there's an old saying out there that the markets stair-step higher and go down like an elevator. Well, when I said I got back involved in the market yesterday, because the way this market went up, this was just a panic run to the upside, and there is no real backing and filling or stair-stepping as this market goes up, which increases the odds that we will come back down through it. Now, typical questions that I'll get from people that have followed what I've done and followed market profile over the years will say, well, there's really not much excess on the high in here. And then you've got, no excess yesterday. Now I have this in 2 tick increments. So, you may have it in 1 tick increments. Maybe it shows a little differently, but there's no real excess on that high. And that confuses a lot of people because there are 2 exceptions. A lot of times when there is no excess on the high, that is an indication that inventory has gotten too long. And when inventory gets too long, very often the markets have to break before they can rally. So I was aware of this yesterday, but I didn't let it stop me because I could well recognize what had gone on before has an awful lot to do with what are the expectations for the market going forward. And the market's been up for a long time. I showed you the 4 gaps, which always is a sign to me of a market that's overextended on the upside. And then this gap feels more to me, it's not a term I generally use, but it's more like an exhaustion gap, and it's more like a gap created by the laggards that finally get into the market. So now, as I say, we're in a liquidating mode this morning. And a lot of times when you get a market that's been going up the way the current market has been going up, it takes a catalyst a lot of times. The market doesn't, it doesn't control itself very well on its own. You need some kind of catalyst, some kind of shock effect. And I think that yesterday afternoon, when we got the minutes from the FOMC meeting, and it was clear that the Fed, there's been talk that the Fed, said they would continue to raise rates, although at a slower pace. But I think the reality hit in yesterday afternoon. And the short-term traders, sold it off a little bit, but then they brought it back late. So traders do what works till it doesn't work anymore. So the shorter-term traders were more oriented towards just buying every break without any other consideration. Overnight, the overseas market took it a little more seriously. So now where we are, we're going to open up here in just about 15 minutes. The market is attempting to fill this gap. So the gap trading guidelines are applicable this morning. Remember, if you were with us yesterday on the webinar, we had a gap, and the gap trading guidelines were go with all gaps that aren't filled. If the gap is filled, which yesterday's was, then the emphasis shifts to developing value. Now, if you take yesterday's developing value, there is it was a shortened day on the 3rd, on Monday. It still is a countable day. There was the value area high from Monday. Yesterday, the market's trying to go up all day, and your value was overlapping to slightly lower. Also, if you notice the shape of this is the P shape, and the P shape formation is more of an indication of short covering rather than a more enthusiastic representation of short covering and new money buying. The market profile is it's a graphic. It's a distribution curve, but a distribution curve is also a graphic. A graphic is also known as also known as an informational graphic. And the informational graphic conveys some very complex tones to the market in a readable form. This structure or this graphic represents short covering or old business rather than a healthier sign of old business and new money buying. This is a very unhealthy sign and usually leads to at least some liquidation. Now, just before we go to commercial, we have another potential gap to the downside this morning, with about 14 minutes to go. The gap trading guidelines are applicable again this morning. The gap trading guidelines, once again, are as follows. Go with all gaps that aren't filled fairly quickly. And no, I can't exactly tell you what fairly quickly is. You see it. The best shorting opportunity is if the market attempts to fill the gap and both the pace and the volume slow. Tempo or pace, column, the speed at which it goes up and the volume decrease, that's usually your best shorting opportunity. If you don't get any kind of attempted recovery, that's usually a sign of continued weakness. Your indication, your filled gap from Friday is your current downside reference. The last thing I say before we go back to commercial, the larger the gap, and this is a large gap, the larger the gap, and incidentally, we measure gaps from the previous day's high or low, not from the settle. So this gap is measured from yesterday's low. The larger the gap, the lower the odds that the gap will be filled. The reasons for that are, number one, traders that went home long that don't trade overnight, have to liquidate this morning. Secondly, more than likely, there will be margin calls. And the word on the street is don't meet the margin call with money, liquidate the position in there. And third reason is that the majority of the world are momentum traders. We're not momentum traders. We respect momentum. What we do at the market profile, we put context around momentum. But the momentum indices will be adjusted downward because of the price movement to the downside. So those are the three reasons that the larger the gap, the lower the odds that the gap will be filled. All right, let's go back to commercial, and then we'll do a couple minute commercial, and then we'll come back and we'll be here for the opening. Jen, you want to go through some of the details of the primer and the foundational e-course, please?
Sure, 1 second. Let me take back the screen. Okay, so for anybody who's new, I just wanted to point out a few things on our website. If you go to jimdaltontrading.com, our official Twitter, and our YouTube channels are here. There are a lot of fake Twitter accounts, so if you want to make sure you're going to the right one, subscribing to the correct one, directly access that from our website. But if you go to courses at the top navigation, that's where you'll find the market profile primer featured up at the top. As we had mentioned before, it runs from August 2nd to 10th. It's an 8-day course. The first 4 days, we will be teaching linear sections that we have from our foundational e-course. And on the 4th day, something that to differentiate it is we do plotting of the profile manually as an exercise together. It's something that we give you the instructions for in the foundation e-course, but we do it as an actual exercise live in a webinar to help people learn it. It's not difficult. It's just one of those things that when you don't know how to do it or you're just reading the instructions, it's really helpful to do it as a live exercise. And it's kind of like rinse, repeat. But usually a lot of folks have a trouble doing it to begin with. And it's a very helpful exercise. And it's something that we recommend that even though you may have market profile charts to obviously plot everything, do everything automatically for you, we really want to focus on the concept, the pillar concept of value. And that's why we recommend that you actually plot the profile manually for a short period of time so that you understand and have the imagination for how value can change and just appreciate that concept a lot better. Jim, I don't know if you want to add anything to that, but
I do. Thank you. I did the profiles 7 markets manually for several months when it was first available. But Jen hit on the key word, and it's imagination. Successful trading is creative problem solving. Creative problem solving involves imagination. When you learn how to do the profile rather than just look at it where somebody else has done it, when you do it yourself, it gives you an greater in-depth understanding of what will cause the profile to change. And I think it will help your imagination. Jen, thank you.
Okay, and then as we said, the latter 4 days, Jim will be narrating the market, whatever comes at us, and also be providing a daily reports, which is our form of homework. Just gives you a really good idea of all the variables coming together and whatever the market gives us in terms of the concepts and everything, we try to point that out to you. And it's also to just really teach you how we observe the market. So if you have any questions on if this course is right for you, by all means, go to our website. You can shoot us an email at Dalton@JimDaltonTrading, or also give a call, and I'd be happy to answer any questions that you have. But really, this course is for somebody who's new to market profile, wants to figure out at a low cost if this is for them. Somebody who knows enough, maybe just a little bit enough to be dangerous, and you want to make sure you understand the concepts as Jim teaches them. Or if you are experienced already and you just want a really good review, or maybe the latter 4 days of Jim narrating the market is what you're really interested in. So anyhow, just to also point out, the foundational e-course that Jim spoke about, you can go and find more information on our website about that. But that e-course is what the prerequisite requirement is to join us for the live intensive this fall that Jim mentioned. Even though we haven't made the formal announcement for the intensive yet, that will come later this month or in early August. And it will take place in the month of October, in case you're wondering. But as all of our programs, live programs, all of the webinars are recorded in case you live in a time zone for which you can't attend all of them live, or maybe you've got a day job and you're not able to attend all of them live, or you just want to make sure that you're able to go back and review things. Everything is recorded. For the primer, you will get access to the materials of the primer that you purchased for 3 months after it finishes. For an intensive, you get access to it for a year after that finishes, since it's so webinar intensive. If you've got any questions on any of our courses, like I said, just give us a call or contact us and we'll be happy to speak with you.
Jen, let's go back to the market, take just a few questions, and then we'll talk about the opening.
Okay, I've given you the screen back.
Thank you. Any questions?
Yes. Okay. Is there a significant big difference for Jim between him trading the TPOs back in the 80s and today? And if so, to what degree?
No, there is not. There are a lot of things early on when the profiles first came around that I don't do anymore, but I still remember there's 3 components that make up the profile. There's price, which is an advertising mechanism, time, which regulates all advertised opportunity, and volume, which measures the success or failure of those advertised opportunities. Those are the 3 components to any transaction that is financial in nature. And no, I have not made any changes to how I use the TPOs and count. I mean, certain things like we don't do TPO counts anymore because that was designed for floor trading. But to look at the volume and the structure of the profile, nothing has changed. Remember, the profile is nothing more than a distribution curve. Scientists have used distribution curves forever to record data. Once the data is recorded, then it's easier, I don't mean recorded, but to organize the data. Once the data is organized, it's easier to tease information from it. Time, to have a distribution curve, you need a constant and a variable. Time is the constant on the horizontal axis. Price is the variable on the vertical axis. So it's simply a way to organize the data. Make it clear to everyone, we are not profile traders. We are discretionary traders. We simply use the profile to organize the data. Once the data is organized, it is easier for us to tease information from it. Next question.
Okay. Can you ask Jim what he looks at the SPY, since he's got that on the left there?
I don't look at it. Well, the only thing I really look at on the SPY is the volume, how it changed at each price. But I take the information for trading the SPY, I take off of the ES. I do trade the SPY. And particularly in my investment account, I take some longer term positions sometimes, but I also use SDS and SSO, some of the ETFs. But the main information that I use to make trading decisions on vehicles related to the ES are directly from the ES. Okay, what else?
Okay. Do you consider that the last day of the month or quarter played a part in Friday's gap?
Oh, I think it did. I think the fact that it was pre-holiday, a lot of people going on vacation. The momentum had been up for some period of time. The numbers, look to be somewhat positive to a lot of short-term traders, and I think there was just that natural momentum going in there. And I think there's also one of the things we've been dealing with I think the longer term money, what I've been calling the pain trade, I think they've been underinvested. And I suspect there was a little bit of window dressing on the buy side in there. But I think more importantly to me was it looked to me to be a emotional move rather than a move that was backed by good, solid buying. And of course, that's what, as I said, that set me up in a whole different, just the way it went up on Friday set me up in a whole different attitude in there. And it just had a feeling to me that the market was to the point where it was time to enter into some kind of a corrective phase. And then, but I know, that usually takes some kind of catalyst when the market's been this aggressive. And I think we're wrestling with the catalyst right now. I mean, right now, nothing's really changed. Remember, we're 2 minutes from prior to the opening. The market will gap lower at this point in time, gapping through a gap, but it hasn't closed that gap. So what's going to be really important is if this market can close the gap today, then there's really no change. All you got was a little inventory correction. If the market's got weakness today, you will close the gap and you will start to find some acceptance back down below the high from the 29th. Okay.
Okay.
One more question before we monitor the opening.
Sure. I appreciate Jim's big picture view with the gaps on the first slide. On that slide, gap 3 was a result of rollover. I've not been sure whether to view that as a gap since it doesn't appear on the profile. Could Jim comment on that?
Yeah, that's always an issue. I simply take the bar charts as presented by TOS, and I don't make a science out of it. But I do use the bar charts as presented by TOS. Is it perfect? Absolutely not. But again, I don't quibble over one gap or another. I mean, it's just a bigger picture orientation. And I really make my decisions on what's going on a daily basis. All right, so we're going to stay here just for a couple minutes with the market open. My machine, because I used to have just a laptop, but I now have 3 other monitors with an awful lot of markets loaded on them I didn't used to follow. So it takes just a little bit of time for my machine to catch up. It's a little slow. I've got to do something.
You want me to show my screen, Jim? I can show my screen.
Sure, please.
Okay. 1 second. Okay. There we go.
All right. So there you can see that the first attempt, that's a large gap. The first attempt is for short covering from overnight. What becomes relevant in here, this is a large gap. If a large gap is to be filled, normally the buying will start almost from the opening, and you'll see quite a bit of confidence. So far, this is just very, very early, but it hasn't shown significant confidence so far. But it is a gap within a gap, which is a very unusual circumstance. But I think we have to let this play out. The overnight inventory, of course, with the lower gap, the overnight inventory will be short. The odds are always very high that you get a counter auction or a correction to overnight inventory. As we say, what doesn't happen is often as important or more important than what does happen. So if you don't see a meaningful counter auction to this very short overnight inventory, that's usually a sign that at least on a short-term basis, the market is fairly weak. One of the things I say, if you ask an amateur, what did the market do today? They may very well tell you exactly what the market did and very accurately. You ask a professional trader what the market did today, they will also include what the market could have done that didn't do. And that is extremely valuable information. For example, this market could close the gap this morning. If it doesn't close that gap, that is very valuable information. So what doesn't happen can sometimes be as important or more important than what does happen. So right now, the next lower reference, of course, is the overnight low, which is just a couple of ticks below that. The next reference, of course, would be filling the gap. As I say, generally speaking, if you've had a large gap, and this is a large gap, if the large gap is to be filled, you normally see buying begin exactly at the opening and be pretty strong. So now the obvious target is to fill the gap. Markets can see that in there, and that's what they're trying to do right now. The traders have a tendency to go to things that they can see. Okay, Jen, a couple of final questions before we say thank you.
Okay. Do you include the night sessions in your market profiles, specifically in the financials?
No, I do not. I'm aware of what the overnight does, and I'm aware of, the odds are so great that overnight inventory gets corrected, but I do not include them. And what happens overnight does not correct what happened during the daytime frame. Okay, next question.
Okay. Now that it's been a while since they changed the end of the regular trading hours for futures, do you include that final half hour in determining the high or low of the day if it occurs during that period of time? Or do you ignore it and stick with the old 4 p.m. Eastern closing time for that?
I used, as Jen will tell you, I spent 2 or 3 months, making an evaluation of what I thought was most appropriate. And I finally settled, I used the NYSE 4 o'clock closing time in there. Okay, now, before we leave, remember what I said, you got a large gap. The large gap, if a large gap is to be filled, you normally get buying right off the opening. And of course, you've got none of that this morning. So the gap has now been filled. Let me say thank you very much. And I hope you consider joining us for some of our educational programs. Again, thank you very much.
Thank you for joining us, everybody. This has been recorded. We'll get it posted as soon as we can. If you've got any questions at all, like I said, please go to our website, and you can contact us via email at the bottom at our contact form, dalton@jimdaltontrading.com, or give us a phone call, and I'd be happy to answer any questions that you have. Thank you so much, and have a great rest of your day. Bye-bye.